Hi everyone, welcome to a brief update with RobecoSAM's Pieter Busscher, who manages the Smart Materials Fund. As many of you know, a lot of market volatility going on at the moment, so just wanted to cover a bit of an update on the market, the types of areas he's looking at, and what he's been doing in the portfolio really. So over to you, Peter. How has the COVID-19 pandemic impacted, the level of demand and also the supply chains of the companies that you look at?
Yeah, hey, John. As the virus spreads, we start to see clearly an impact on some of the supply chains. That first happened in China, and there we've already seen that reverse after China went into lockdown, and now talking to companies out of China and Korea, we kind of hear that 80–90% run rates in terms of utilization are back with some of those companies. But in Europe and North America, we've seen the suspension of some of the productions. The country that has probably managed it the best is really Korea, where we haven't really seen that impact and where they continue to operate actually fairly well. So on the supply side, I think we will see that a bit more, especially now in the end of the first quarter and second quarter. But what we're only going to start to see really is the demand side, and I think we've seen a little bit of that now coming through in the numbers in the first quarter. The main effect should be in the second quarter, and we continue to have an impact in the short term for sure.
And how have you been managing the portfolio given the volatility and these changes in demand supply?
Coming into the year, and in general, we're positioned really around long-term themes, around efficient materials, the reuse of resources, and smart manufacturing. Our strategy really focuses on bottom-up stock selection. So while at the moment, clearly macro factors are at the center of everybody's attention, for us, really what's interesting are the specific stocks and the opportunities. And while it is a very challenging situation on many levels, it's been a great opportunity for us to buy into some stocks that have been on our short list for a very long time, that were relatively expensive. If we look at the new displays OLED situation, we've been investing in some of the Korean players for a long time, but some of the leading players in the US were always very expensive. And as we saw that correction, we were finally able to invest in some of those. Similarly in robotics as well, where we saw some interesting opportunities coming up in names, and where we were able to shift some positioning into that, while on the other hand we were reducing other exposures, especially where we got a bit more concerned around the oil and gas situation, and where that might have been a bit more of a revenue exposure, and then shifting into those that we think are better able to weather the whole situation. If we look at the biggest position we have, IPG Photonics, I think that's a picture book example where they've been challenged in China now for a while. We've looked kind of coming into the year as China as the big risk, and now that's starting to turn around. So really Chinese exposure is actually where we would expect the markets to come back a bit more quickly. So that's something that we're trying to reflect in the portfolio already now as well.
And any of those four themes that you focus on more challenged, that you're more concerned about?
I think anything that's oil and gas related is a bit more challenging for us. Directly, there isn't that much exposure. I think it's more on the chemical side. We've had some exposures into names like BASF that have some exposures in there. And we've been trimming that position, and rather than change into alternatives that don't have the upstream exposure, because that area may last for a bit longer, just looking at the demand destruction in oil in the short term. But yeah, the opportunities we think are really in the secular stories, where we see that we're going into a very challenging period, and really to come out of that period, I think companies really need to look at their investments and the opportunities, and also the footprints. And we think that's kind of one of the main takeaways here. We've seen this extended period of trade war and trade challenges. Now we see that visibility into supply chains becomes more and more important. So we think that will really lead to a rethink in terms of a lot of supply chains. And we think software companies will be well placed, but also automation companies will be quite well placed. And maybe something that would have happened naturally in some years is potentially then fast-tracked really due to the situation.
And performance of the portfolio has been pretty resilient, really, particularly in light of some of what's been going on in the sector generally. Can you just give us a bit of a summary on performance and what the key drivers have been?
Yeah, so kind of if we look through the year-to-date period until end of first quarter, what we see is very strong period initially in kind of into February, in that period leading up to Chinese New Year, and before the whole Corona situation really started to have an impact on markets, where order flow out of China started to improve again, given the phase one deal of the trade settlement between US and China. As we continued into the situation with China going on lockdown, we performed quite well, even outperformed the world markets. As the volatility then really increased mid to late March, where we had volatility readings similar to the global financial crisis, we did suffer a bit more versus the general indexes. And I think here what we see as main drivers are really some oversold situations on stronger names, where maybe there was more selling pressure out of the investors that were in there in general. But we would expect those to reverse really as the market stabilizes, and I think investors really see the long-term opportunities in those names. And IPG comes to mind here again, where we basically see the stock really be pressured quite a lot, despite strong outlooks here.
And have you made any meaningful changes? I mean, of the worst performers, what have you generally been doing to those positions?
Yeah, so some of those, I think that the area that probably remains challenged for a bit longer is around aviation, given what's going on with that industry and some of the lightweighting names that we have there. These are very well positioned companies, well-run companies, but as fleets are grounded and producers are challenged, this will take longer. So here I think we're trying to really, on a stock by stock basis, see what are the best opportunities. And here we see opportunities, for instance, in industrial gases, an area that we haven't been invested in for a while, also due to valuation. But basically what we've seen, a fairly resilient industry like industrial gases has corrected actually pretty much in line with the industrial sector, which we think is not correct. So we see opportunities here. And these are some of the portfolio switches that we're making then.
And what's that done to fundamentals of the portfolio? I mean, what do valuations look like, and I guess expected growth figures as well, given the shock?
Valuations, I think, just looking at a number of metrics, look very attractive. I mean, normally we look at PE. PE at the moment, I guess, is not an easy metric, given what's going on. But just on a relative basis, we see about an on par valuation on PE versus the MSCI World, with 10% more growth for the strategy. We're at half the historic PE level over the 5-year average. Also on EV/EBITDA, we have a pretty good discount of about 3 points versus the world index. And kind of looking at more long-term metrics like price to book, the strategy is also about 10% cheaper than the MSCI World. So I think just looking across that range of valuations, I think on a relative basis, we're well positioned. So assuming that we can overcome the situation and we start to see growth coming back and kind of a reversal of this in the third, fourth quarter and into next year, I think that's a pretty attractive situation at the moment.
It's impossible to know where or when this crisis is going to end, but in terms of how you think you might perform, how you think the portfolio will perform in different scenarios, how do you think it will get on in a decent, quick recovery versus a more prolonged kind of downturn?
Kind of starting with the more negative scenario first, we see somewhat more limited downside, I think, for a number of companies that I think have been impacted also to some degree in the past year already, because they have been challenged by the trade situation. So we don't see that much more downside. Whereas on the other hand, once we see that rebound and the reversal, and we've seen part of that already in the beginning of 2020, we would expect a very strong return, because now there are clearly a lot of incentives in general for people to invest again as trade becomes more open. But we also think that structurally supply chains will become a lot more professional, and we think that's going to be a big theme coming out of the corona pandemic, as we contain it, to really set up production in a way that becomes a lot more digitalized. I think that's by now the last company will have understood that there is no other way to be prepared for the future.
Thanks very much for your time, Pieter, and look forward to speaking again soon.
Thank you.